In the next section, we're going to be looking at decision point trading, or trading off of key pivots on the chart. At OFA, we call it decision points because to us, it's the ability to isolate a point on the chart that you know if and when you get there, you're going to have to make a decision. It should either be a target or an entry for a trade going the opposite direction. We're going to be looking at the basic rules and nuances of how to locate decision points and how to trade off of them, as well as set ourselves up with an algo that we'll be using in the next 4 example lessons. Simply put, a decision point is a key pivot on a chart that we've traded to, such as this low. The idea behind it is that if mapped out properly, we should see the market retrace to that same low and bounce off the market and turn the other direction. These are essentially fades or reversal trades. Most of the lessons will focus on reversals from key lows and key highs on a chart, but you'll find throughout the other lessons in the course that very often decision points are breakdown and breakout points as well. The decision point profile is very simple and only has a few items enabled on it. You should see the profile or the histogram, as well as the value area, which is represented in blue here. The yellow line is the point of control or the single price within the profile that has the most volume. We'll be using the value area and point of control as our key points to build an algo off of and to trade off of. One of the biggest obstacles that new traders face when using decision points is that they quickly assume that every point on a chart is a key decision point. In order to overcome this, I'm going to try and take you through a few basic rules that will help you isolate key points on the chart and avoid over trading off of every turn in the market. The highs and lows that we're going to be using for decision points are made up of volume transitions. What we mean by a volume transition is a point on the chart where we can see the volume clusters within the actual periods create a transition. So in this example, the market is moving lower with periods moving down. We can see here that the cluster of volume is at the lower end of this period. Let's think about what had to happen in order for this period to be created this way. The period opened here and upticked a little bit, then began to move down. At some point, I assume there was a cluster of volume higher up in this period. As we were breaking down, it was probably a red period like this one here. But down at the low, new volume came in to stop the downward action of the market. Buyers came in to prop up price, and that shifted the volume cluster down to the lower end of this. Because we upticked and closed the period, this volume cluster is classified as neutral. That's why it's blue. So we have a move lower, then followed by buyers buying up and through the prior volume cluster. There's a transition going on here from seller to buyer, where we can see the buyers buying through the previous selling effort. We can see something similar here as well. It's a bit more spread out. We have sellers driving down, sellers driving down, sellers driving down, but unable to finish the move lower. We end up closing above the volume cluster, and then we have a period that drives through all of that selling effort. This is a transition from seller to buyer. Up at the top, we have a buying effort followed by a stronger buying effort, which then rotates and we have sellers drive through the previous buying effort. This is why looking at the periods with volume clusters in them is so important to us. We want the software to classify these periods for us so that when we're trying to find decision points on a chart, it's a very simple process of simply looking at the volume that was pushing the market one way and seeing where it was overtaken by volume coming the other direction. As we look to find volume clusters on a chart, there are a few key elements we're going to be looking for. First, not every high and low in the market is important. We're going to be looking for key transitions that frame either the day or a major range. So if we look back at the prior day, we can see that there was a low down here and a high up here. The high up here was actually very similar to the highs that came in prior for that day. So we had an overnight high followed by a London high, followed by a U.S. equity session low at 8:30. We then traded in a range almost all day between those levels until we finally came back up and retested the high. We're going to see major transitions take place at the highs and lows of days and at specific times during the market. An example of that is this 2 o'clock high. When we have a high at 2 a.m., that's representative of the London open. So when London traders start coming into the market, we get an influx of volume. That influx of heavy volume will create significant transitions or key points for us to trade off of. The same is true at 8:30 Central Time when the U.S. equity markets open. We're also going to look for key decision points at every half hour after the U.S. equity opens, so the top and bottom of every hour. So in Central Time, at 8:30 the U.S. equities open. At 9 o'clock, we're likely to have another huge influx of volume. Why, you might ask? Well, I want you to think about all of the indicator-based trading that you've done in your past. You're either going to be looking at hourly or 30-minute candles or 15-minute candles, something to that effect. In order for a trigger to happen, you'll need a candle to close, you'll need your indicators to all line up, and then you're going to immediately execute a trade if everything is lining up right. Well, what that translates to is every half hour, there being a very large influx of new volume throughout the morning session of the U.S. futures markets. So we begin looking at 8:30, and we look at 9, and we look at 9:30, and we look at 10. And that's generally when we're going to see major highs and lows for the day. So time is going to play a major factor into whether or not we're going to look at key pivots on the chart as being substantial reversals. Now, it stands to reason that we will have highs and lows during days that will not happen exactly at the top or at the bottom of an hour. We can identify those individually, see if they look like a clear transition from buyer to seller. We can look to see if they held as the high of the day, and we can assess them independently. It's important that we get a basic guideline to start with, and once we've got that, the next thing that we want to start looking at is the actual shape of the distribution of volume. In profiling, we're generally looking for what's known as a normal distribution of volume. I'm going to add another profile here to this low down here, looking for the move down, followed by the volume that transitioned back up through the move lower. Notice that the shape of this profile is a bit like a bell curve on its side. That's known as a normal distribution, where we have a significant amount of volume in the middle, tapering off in either direction towards the high and the low relatively evenly. This is a normal distribution of volume, and this is ideally what we're looking for. If we have a normal distribution, we should have a point of control somewhere in the middle with a taper that we call the finish. Even this example here has a bit of a taper down to the finish, to the edge of the profile. The same is true with this one here. The ES generally will produce normal distributions on reversal points because of the amount of volume that it takes to move the ES. It's a very large, bulky contract. When we look at other contracts, that won't be the case, and we'll see many different variations, and it's important that we get a sense for what we want to trade and what we should avoid. This is the euro, which is a much thinner trading market. There are two examples on the chart that I want to zoom in on. We'll start with the first one up above. Notice the transition of the periods. We have volume pushing higher, followed by sellers breaking away from their cluster of volume and pushing lower. So when we profile this transition, we don't end up with a normal distribution. What we end up with are two distributions. This is a double distribution of volume where we have the point of control almost on one edge, tapering all the way down, and then coming back out. And note that this level of volume is not even included in our value area, or 70% of where all the volume took place. It's almost as much volume and almost as significant as the point of control. There's very little difference between the two. When we see double distributions, we have to avoid them as decision point trades. There's no logical way to use the data that's in front of us to enter and to properly manage a trade. If we were to enter from the point of control and have our stop up above the value area, we would have our stop on one of the highest volume levels that's in the distribution. It wouldn't make sense. So the shape of the profile is going to help determine whether or not we have an objective of trading off of it. In some of the examples that we're going to be looking at, we'll look at very complex scenarios where it's not a simple situation where there's only two periods that are creating a volume transition. And we'll learn how to move the profile around to properly find a good normal distribution that provides us with an accurate risk to reward proposition. Now let's look down at the low. If you notice, this distribution is quite a bit different than a normal distribution. It's heavily weighted towards the bottom. I've even drawn some lines here to show how it sort of looks like a wedge down at the bottom, or a shelf, where we see a lot of volume all in one place but tapering off towards the low. Up above, you can see there are other prices that are included in it that are sort of flat compared. This is also an excellent type of profile to trade off of for a long. If you flipped it upside down, it would make for a good short. Our expectation would be that the market would trade down and bounce off of the shelf without penetrating it and trading all the way through. Now let's look at the YM. I have several different profiles on the screen. You can see a normal distribution over here. In this case, we have an inverted shelf where most of the volume is towards the lower end of it and it's tapering off towards the top. We also have one down here that sort of just looks like a big block. It's hard to distinguish where the bulk of volume is or where the distribution of volume is because we have almost four individual points where volume is shooting out. Profiles like this, it's going to be very difficult to find the market actually trading all the way into the point of control. So it's important for you to remember that in these decision point trades, we're going to use the point of control as an entry point, but we're going to do that knowing that there is always a chance that the edge of value is the only place that ever gets revisited. So it will be important as you begin testing and challenging these decision point concepts, figuring out from the shape of the profile that you have where you want to enter the trade and how much risk you're willing to put up with. In this particular example, in order for me to trade this and have a good chance of getting into the trade, I would need to execute in front of the value area. I know that the other side of value is where the trade no longer makes sense. This is where my trailing stop is going to be. So that means that because it is a block of volume or multiple distributions all jammed together in the value area, I'm going to have a much larger exposure trading from the edge of value than I would from the point of control. I can certainly put my entry at the point of control and use a 1, 2, 3, 4, 5, 6 tick stop rather than a 9 or 12 tick stop, I guess 12 or 13 tick stop. I could do that, but I'm going to take a risk that I won't be filled on the trade. Very often, all we're going to do is trade down into the edge of the block of volume. Now, I want you to contrast that to what we see up above. The profile here, we can see, is almost a normal distribution, but the point of control is much higher towards the top than it is towards the lower edge of the profile. This provides us an excellent opportunity to take trades with a very, very small stop. So I want you to imagine that you're taking a short one tick in front of the point of control, and our stop is going to be just outside the value area. That leaves us with a 1, 2, 3, 4 tick stop. Now, a 4 tick stop in trading is phenomenal because that means all we have to do is get 8 ticks out of the trade, and we've made 2 to 1 on our initial risk. So we're going to be looking for trade examples and looking for profiles that provide us with an excellent potential return on risk to reward. We want very, very small stops when we're decision point trading. Part of the reason behind that is because we're essentially going to be trading against the momentum of the market. we're betting that we know where the market's going to stop. And if we take into consideration the time, the significance of the pivot, and the shape of the profile, we should have no problem being 50 to 60% accurate on these trades. Remember, if we're making 2 to 1, we only need to be right 33% of the time. If we're making 3 to 1, it goes down significantly. 4 to 1, even more so. So our objective is not to be right all the time. It's to be right and make money. The times that we're wrong, it's okay because we'll be losing very little, and we know that we have a higher probability of catching these bounces than not. This profile is an example where we see a bit of a shelf inverted. So in the previous version, I had drawn of a shelf or a ledge on the bottom. In this case, we have a shelf or a ledge on the top, meaning that it would be very difficult for the market to trade back through this without bouncing off of it. The only difference between this and the prior example that we looked at here is the size of the stop. To get in front of the point of control here, we have a 1, 2, 3, 4, 5, 6 tick stop. Whereas here, we're looking at 1, 2, 3, 4, 5, 6, 7, 8. We've increased our risk by a third just by having a profile that's as spread out as this one is. The same is true here. This is a larger risk than we would generally be looking for on a decision point trade. Now, please note that I've just randomly drawn some profiles on highs and lows. These are not significant turning points. This is in the middle of the night, at 10 o'clock at night. So there's nobody actually trading here, and this is not a real decision point. I'm simply trying to give you examples of what profiles look like. So as we are going through example trades, we're going to be looking for opportunities where we have a very small risk to trade from the point of control, and we'll understand that much of the time we'll only trade to the edge of value as we did here. If we're comfortable with the risk exposure to utilize the entire value area, you can obviously take these trades from the edge of value and use the opposite edge of value as well. That's what's so nice about using the AlgoX interface, is that it does all the work for you. You just need to decide where you're sending the trade. Also in trade examples like this, that's a time when we would absolutely be looking to do that. Again, if we can afford the risk of the downside of the trade. So let's flip back over to the ES example, as this is going to be the first trade example that we go through in the next lesson. Ideally, what we're looking for is to trade one tick in front of the point of control and use the bottom of value for our stop. We're going to go in and build our first execution algo for decision points. And if you remember, the last algo that we built was based off the volume-weighted average price. Well, you can see on here, we're not even calling up the volume-weighted average price. It's not even on our register. So what we want to do is create a new algo. We're going to call this one value, and I'll use the 2% value on this one as well. This time, we're going to be sizing off of the value low price and the value high price. Now, note in the list, there are two different variations of this. The first one has value high price first, followed by value low price, and the second one is value low price, followed by the value high price. The naming convention that we use assumes that you're taking a long first. So if I'm going long off of the point of control, I want to make sure that I'm sized off of the value low price. If I'm going short off of the point of control, I want to be sized off of the value high price. So I want to create my algo using the VLP, VHP. Just like before, I'm going to offset this by a tick so that I'm always one tick behind that value area. And again, I can create minimums if I want to and auto cancel features. Now, I've already created a take profit algo that I think works for every example that we're going to use. Obviously, that's something that you can dial in on your own if you want to take profit at different levels, or if you find that you're only executing 2 contracts or three contracts, so it doesn't make much sense for you to have a 5-to-1 level with those other levels involved in there also. That's fine as well. On the management side, remember that all we've done so far is size off of the VWAP because that's what our trend-based trades were using as their stop. In this case, we've got to change that up a little bit. Let's think about what we're going to be trying to accomplish before we build the management algo. We're going to be putting a trade on based on a static profile. We're not going to have access to a VWAP. We're not going to have access to all of these other things. But we do know that our hope in the trade is that it takes off and starts moving in our direction. So if we get filled down here and the market starts moving up, there has to be a point at which we're willing to say, okay, now I want to start using a different management style. I can't just leave my trailing stop over here because it's never going to move if it's attached to the value area of a profile over here. So we want to go in and build a management algo that after a certain amount of gain in our trade, we know that we can move our profile over here and start using a live profile to track our trailing stop off of. We're going to create one that's very simple, and I want you to know that you can always intervene with this and move things around. Under management, let's create a 3-to-1 VWAP. We're going to add it and create the step, which is just 3-to-1. And at 3-to-1, we're going to move our stop to the VWAP minus 1 tick. Now, you can make this as complex as you want. You can say that after a gain of 5-to-1, I want to jump my stop to the upper standard deviation. You can jump it to the edge of value. You can use any of these other variables that are included in OFA. My suggestion is that when you're getting started, you focus on a very simple strategy to make sure that your stop becomes dynamic. And then after that, you use the move stop features that are over here until you get a system down that makes sense for how you're trading on a regular basis. There's no way that I can put in fixed variables for all the different markets that we're using in these examples and have it make sense. The reason is that we have contracts like crude oil that move very rapidly and trend very well. We have contracts like the ES that churn quite a bit and take a long time to develop, building a tremendous amount of volume. So the stop moves are going to be based on how well the trade is performing and whether or not the market is moving in our direction rapidly or if it is churning and slowly creating big mounds of volume that we need to deal with. So my suggestion is to keep it very simple during these lessons so that you get the hang of it, and we'll start moving stops around and helping you build out a better strategy. So let's dig into the first lesson, and we'll get you set up with decision point trading. You'll get to see how easy it is to take trades with a very small 3-4 tick stop and make multiples on it.